You're listening to the RE Social Podcast with your hosts, Andrew and Vince from AnVi Invest. For more information, go to anviinvest.com.
What's up, you guys? Welcome to another episode of RE Social Podcast. And today we have our man, Ben. How are you, Ben? Welcome to the show.
Hey, Vince, thanks so much for having me.
Thanks, man. And tell the listeners, who don't know who you are, what do you do in the space of real estate?
Yeah, so I own a firm called Redwood Capital. We are a asset-agnostic in that we do not have a specific asset class within real estate that we focus on. We are really true bottoms-up cash flow analysts in that as long as the numbers work, even if it's industrial, multifamily, mobile home parks, RV parks, or even non-performing loans, we're able to underwrite it and acquire it. And as long as our forward-looking analysis shows that the risk-adjusted return meets our hurdle, we go ahead and execute.
That's awesome, man. And now, Ben, do you own personally any assets as well?
Yeah, absolutely. So I have a portfolio. I'm an investor in every deal that we do. We have several syndications and then a few closed-end funds. I own approximately 16 buildings myself.
Oh, that's awesome, man. And what kind of asset class did you pick for yourself?
So when I first started buying buildings, I was on the buy side working for a hedge fund. This is back in 2013, so about 11 years ago when I was in my early 20s. I'm from Westchester County, New York, which is the suburb right above New York City. I chose to start buying small, like multifamily mixed use, like workforce housing, like 4 one-bedrooms over a bodega kind of thing in Yonkers and Mount Vernon, which is on the border of the Bronx.
Okay, that's cool. And then how did you, how did you get into this whole line of buying, like you can't just graduate from high school and get into this game, right? So how did you do that?
Well, so after I graduated, I went to college. I went to work for Barclays Capital Investment Banking, high yield capital markets. I was there for a little bit over a year, and then I made my way over to the buy side, and I worked at 2 or 3 different special situation credit opportunities hedge funds, investing across the capital structure and first lien, second lien leveraged loans, all the way down to post-reorg private equity and trade claims. Really a generalist in that I did not have a specific sector that I focused on. It was more situation dependent. And while I was working at these places, I was fortunate enough that I was able to analyze probably most industries under the sun, from metals and mining to tribal casinos to inland maritime, software as a service, bowling alleys. So I really got a phenomenal education in being able to just underwrite companies or assets solely based on their cash flows and their valuations around them. And as I moved on in my career on the buy side, I got much more into distressed and stress situations, bankruptcies and restructurings, where we would be buying subordinated debt for pennies on the dollar, in a loan to own situation, coming in, taking over the company, kicking out management, putting new management in, really just positioning the company for success upon emergence. And what happened, how I got involved in real estate was I started doing well at a young age. And one of the best things I ever did was I made a rule that every year when I would get my bonus, I would take 50% of it and put it into bricks or buy a building, a small building. And this is back when you could buy, like in Yonkers and Mount Vernon, like I was buying like a 4 unit apartment over a bodega for like 220 grand.
Wow, that's is it pre 2008 or is it post?
No, so this was like 2013, where things were trading at like on a price per unit basis in these areas of no more than like 60,000 a unit. I mean, just to kind of give you a little like time check comparison. I mean, some of these buildings now, like one of the first buildings I ever bought, 186 Ashburton Avenue in Yonkers, New York, like 4 1 bedrooms over a bodega, was sold for 1.3 million like about a year or two ago, and I paid like 240 for it like 10 years ago. It's pretty phenomenal.
That's crazy, man. And how do you deal with being in a blue state like New York, and with the eviction laws and stuff? People, it takes you a long time to get them out if they decide not to, right? Do you have any strategies for those?
Yeah, so it's funny you bring that up because when I first got started, these eviction laws, ETPA, rent stabilization laws, weren't really put into place in the way that they are exist now until 2019. And before that, you were able to implement the value add Section 8 arbitrage, as I like to call a strategy. When you buy the building, you get the tenants out, you renovate to Section 8 standards, you put in the government paying rents, tenants that's 50% higher than market, and then do a cash out refi and sell. But when in 2019, I got very lucky in that about a year and a half before that, I bought a very large non-performing loan, cross-collateralized by over 100 apartments, and I took it through bankruptcy, special servicing, and sold it. And in early 2019, literally 3 to 4 months before these arduous laws were passed, and I mean, I've seen colleagues' net worth go from 50 million to 10 million over this period with these rent stabilization laws. But so when that happened,
Wait, what was that law? What did that law do?
So basically, the law in New York State is that any building that was built before 1979 and is 6 or more units is subject to the rent stabilization laws of New York State, which basically means that the state is now in control of how much you can increase the rent.
And what is that, like inflation plus 2 or something?
It's less. So it's been like at times it's been 1%. So, I mean, you got to think you have you have expenses going up 15 to 20% a year, insurance, taxes, and you're only able to increase the rent 1%. It's just, I mean, it's a fundamental violation of your constitutional rights in terms of taking a private property. I mean, we could talk about this more, but I have a whole opinion on what's happened and what's going to happen in the future. But it's pretty crazy, like in like Chelsea or like some really nice areas of Manhattan, on a price per unit basis, rent stabilized buildings are trading less than in literally very rural, crappy areas of Connecticut. That, like, cities that are in like Waterbury, for example, like a city that's like bankrupt and like not a place you want to be. Their doors are going for 100K a door, but in Gramercy, if the rent stabilized, they're trading at 65, 70 a door maybe. And that, also on top of that, if you want to try to evict, good luck. It's going to take you 2 years.
Now, if your property is 1982 and such, are you good for life, or are they going to gradually increase the years every year?
So it's been pretty stuck at 1979, but they have been passing laws related to what's called good cause eviction, which basically has classified that non-payment of rent is not a proper cause for an eviction.
Mm-hmm. Wow, that's crazy.
I mean, it's crazy, and it's so backward thinking, because at the end of the day, what this law actually does is it reduces the housing stock of potential affordable housings. I know nonprofits that have fire saled their buildings because of these laws, and I know landlords that have boarded up their buildings rather than take the chance of rent them out to someone that's not going to pay rent.
Yeah. So there should be some stats, right? Once they start doing this, I feel like I live in California, or most of our portfolio is here, but we started buying in Tennessee. So the last couple of years, we've only bought in Tennessee. We own a few properties there with our company, but California also has rent control, but it's a little bit more lenient. It's 5% plus inflation. So right now we can go up to like 8-9%, I believe, in depending on what county you are. But some cities like Santa Ana, I think, is capped at 3, which is not good. So we have those same issues, but I find that the investors like me, for example, I'm not wanting to buy here because of this, and I'm now going to a new market, right? Because it's I've spent hundreds of thousands of dollars in lost rent during COVID, and one of the instances, the tenant didn't pay rent for a year, and then the government, we were applying to get the money from the government. The government wrote a check and gave it to the tenant after a year.
It's truly remarkable, and it's going back to your original question. After this happened in 2019, that's when my eyes really opened, and I realized I need to start diversifying to red states, to more business friendly geographies. And that's when I first started investing in mobile home parks in North Carolina. And that's what eventually got me interested and now really all in on the RV park asset class in Alabama and Mississippi.
Okay, so let's talk about more about that. So, you're in New York side in Connecticut, and you're trying to now look at assets. So, this company that you work for, it's you guys raise capital. How are you guys raising
So
capital?
I started the firm. I
Oh, you
own
started a
the
firm. So your
yeah.
firm.
I'm the founder and CEO.
Oh, nice. So your firm. So how are you raising capital?
Yeah, so basically, so I'm lucky because coming from the kind of institutional background that I did on private equity with these hedge funds, I had a pre-built Rolodex of portfolio managers, ultra high net worth individuals, small pension funds and endowments, and those are some of those individuals really backed me when I first decided to leave the buy side. Like when I was telling you before, to buy that non-performing loan, which is when I had to make the decision whether to stay on the buy side in my cushy job on 57th and Park, or roll up my sleeves and be entrepreneurial and take a risk and take out note on note financing, raise 7 million in equity. And luckily, a lot of those investors are still with me today. However, though, raising capital now is not easy. A lot of LPs have been burned from investing in between 2020 and 2022 when rates were lower, lending requirements were much easier, and a lot of these investors. I posted on LinkedIn about this yesterday. I was having a conversation with one of my LPs that's in about 25, different real estate partnerships. He's invested in 2 or 3 of mine, which are, doing well. But, he was expecting to be cashed out, at least from either a refinance or a sale on these buildings. And it's just not happening. And on top of that, he's getting hit with capital calls. So it makes, that kind of a underlying theme makes it even augments the difficulty that's already there to raise capital. And
Yeah.
that's really why lately I have tried to shy away from the traditional syndication model and to lean more towards the fund model, because it's just I do not believe that unless you have a huge team and a huge marketing budget, I do not believe the syndication model is really scalable and sustainable long term.
Okay, yeah. So I wanted to ask a couple of follow-up questions on that. Now, during the 21, 22, 23, 24 time period, did you get caught in any of the floating rates stuff?
So let me I want to be just kind of straightforward.
Yeah.
I do not do deals to do deals. I
Yeah.
The only deals that I buy have to be such a unique, off the run, special situation
Uh-huh.
that I can make my investors and myself a 2x equity multiple on an LP net basis in a 4 to 5 year period, regardless of what's happening with interest rates or the broader markets. So like, for example, like I closed on an $8.5 million mixed use building in Milford, Connecticut, like 40,000 square foot of commercial and, 34 duplex apartments, at a 7.5. I mean, basically I paid 8.5 and I got offers, 2 weeks later for 10.5 to buy it for me. And I only buy off market. If something's on the market, if it's listed online, I will not even take a look at it, because if I don't have an asymmetric sourcing advantage, then it's just, I can't make the kind of returns that make it worth my time.
So are you purchasing these properties with cash, or are you putting any kind of fixed date debt or anything like that?
Yeah, so it depends on the deal. If it's a phenomenal deal and it's a forced seller and they need to move quickly, I'll usually opt more for a bridge debt, or I have relationships with certain life insurance companies that I don't have per se a revolving line of credit, but it's almost acts as one, considering how many deals I've done with them in the past. They're able to close in 3 to 4 weeks. I call them like soft bridge loans. And that's really I source the types of deals I do are either called pocket listings. Brokers have two businesses. They have the one where they get a seller that wants to squeeze every little penny out of it, and they put a nice marketing deck together and they blast it out to 5,000 people and try to wait for the owner to fatigue to come back to reality. And then 2 or 3% of the deals they come across, it's someone that doesn't want to put it on market and really prefers certainty of close and a quick and smooth transaction process. And like I said, when I first started buying these buildings 10, 11 years ago, was when these brokers that are now some of the largest in the areas do the most deal flow were just starting out themselves. So I've spent over a decade building a track record doing, hundreds of millions of dollars worth of deals with them. So now I am that first call. And I can't emphasize enough how important being that first call is. It's literally everything.
Mm-hmm. Now, so, when you're doing all these non-fixed debt and stuff, you just have access to so much capital. You're not really worried about it. If the rate is tripling because you have to refinance it, you can just call your guys and you will just get it like a different debt on it.
Yeah, so typically with these life insurance companies, like there's the maximum prepayment penalty will be a quarter or half a point. Uh, Typically, I do not opt for floating rate debt, and if it's a large enough loan where it is a floating rate, which has only been a couple of times, I will usually put on some type of swap or derivative to hedge my interest rate risk.
Nice, man. That's very cool. And how did you know about all of these things? Did you anticipate these kind of like interest rates will go up this fast and stuff? So you kind of hedged against it and did all these things in the back end, or?
I mean, going back to what I said, I have to buy these buildings so cheap that that it's regardless of what interest rates do, it has maybe some effect, but it doesn't really change the underlying investment thesis. Like I like to say, you make your money in real estate on the buy, not the sell.
So you have a lot of equity NOI going up with the DSCR being such high amounts. It doesn't matter if the debt moves a little bit. You have enough points on top.
Yeah, I mean, like I won't buy a deal unless I can increase NOI by at least 30 to 40% within 18 to 24 months.
Well, that's pretty cool, man. So what kind of assets you guys managing right now, like under management?
Yeah, I mean, so everything from mixed use to medical office, mobile home parks. I have a B and B in Southampton. Um, I own some other kind of alternative assets, a few tugboats and dry barges that I triple net lease operating down the Ohio Mississippi rivers. And I can't really just stress enough that this type of special, I'd like to call special situation asset agnostic strategy, is a direct result of me spending, almost a decade on the buy side, working, managing hundreds of millions of risk capital for institutions, investing in really anything and everything, regardless of whether it's oil and gas or it's a bowling alley or it's a tribal casino, as long as I feel that I have like inside information, because there is no such thing as inside information in real estate or the private markets. I need
Yeah,
an
there's
unfair.
only inside information. Otherwise, you're an idiot. Right?
Exactly. I mean,
Yeah.
I need an unfair competitive advantage that gives me such an edge that it's almost unfair. And otherwise, it's just not worth my time.
Yeah, it's
'Cause
true. So, are you guys in like the hundreds of millions of dollars of assets under management?
Yeah, so in terms of current AUM, like we're between the 120 and 200 level right now, but we're scaling fast, and we're really pushing the growth of the RV fund and platform. We're closing the $30 million fund in probably 2 months, and then we're looking to already do $100 million add-on after that.
Wow, so that's pretty interesting, man. So you guys do like 70, 30, 80, 20 kind of split, and you guys keep the 30 or 20? Is that how you guys run the deals?
So typically we're a little bit different. So we'll do like so we're first in, last out, obviously, until the investor recoups all of their initial investment plus their accrued preferred return. So what we'll usually do like an 8 to 10% hurdle with 70-30 after that, and then we'll do like a 22% hurdle with 50-50 after that.
Oh, wow. So that's kind of interesting. Yeah. I know. I don't know if you know Ken McElroy. He does something like that. After I think 15 or 16, he pops to 50-50.
Yeah, I think it's warranted, and I think it's a sign. It shows investors a sign of confidence in your investment thesis, that you believe that you're going to be able to deliver those types of returns.
Yeah. And then on your side, on the management side, do you have a big team and do you split the equity with them, or is just you just running the show and people just work for you?
So I recently acquired a boutique real estate marketing and investor relations firm, probably about 6 or 7 months ago. Because I'm the front office guy. I'm finding the deals. I'm making the relationships. I'm doing the underwriting, and not also not raising the majority of the capital through my existing relationships. But I brought her name's Kelsey Heath. I brought her on because she has a lot of experience working with much larger real estate syndication firms like Pro Capitus. I don't know if you've ever heard of them.
Oh, of course. I've had Neil on the show a couple of times.
Oh,
I know.
okay. Yeah. So she used to work for them and has assisted them raising, hundreds of millions. So I brought her on specifically because I'm not a marketing or operations guy. That's not me. I mean, and I feel like to get ahead in this business, you have to know what you're good at, and you have to be able to admit what you're not good at and be able to delegate. I've seen so many people fail because they're just too confident and they're not willing to admit that they need to delegate certain tasks. So she has a stake in, and she came on specifically for the RV venture. So she has a piece of the GP in that, and we also I listen. I'm the opposite of penny wise, pound foolish. I want. In terms of even giving my property managers a small piece of the carry, I want my property managers to be invested and to have incentive to do well. Because I'm of the firm belief that a third party property manager will never get a building to optimal, operational standards, versus in house. So I've had to really think of creative ways to kind of counter that. And one of the ways is really requiring them to invest their own cash equity and quarterly or annual bonuses based on them getting a piece of NOI over a pre-agreed budget. And if they, beat that budget enough, having a tiny piece of the carry, because I want them to care. And, because the way I like to look at it coming from the like buy side private equity is the property manager, which is like the most thankless, underappreciated job. They're like the CEO, CFO, they're the boots on the ground. And I'm like the private equity sponsor above them. A good property manager can fix a bad deal, and a bad property manager can ruin an amazing deal. They are so mission critical to asset value, just increasing, especially in a restructuring scenario, and tenant satisfaction. And I can't emphasize enough how important it is to properly incentivize property managers. And then, just getting back to incentivizing, like I'll bring in, I have a board of advisors of which I give them piece of the GP. Two heads is better than one. There's enough money to go around. I'm really in long-term growth mode, and I believe that if I just bring in the smartest people that have the most connections, I'm fine owning 65% of the company and dwelling and dishing out 35% to people that actually really deserve it and can add quantifiable value to the firm.
Nice, man. That's awesome. That's a good thesis. A lot of people don't realize, and when I was starting off, people always wanted to have everything. I'm like, I'll rather have that one house, but it's mine. And I have, we have, over 10 million in assets, but it's just under management, and it's I only own 30% of it, right? And then 20% is owned by Drew, and 20 is owned by my sister. But now it's a better game to play for me, because it's like the assets are valued higher because of inflation. It goes up higher, right? The number you control is higher. But people get caught up. They'll rather own $1 million by themselves and keep 100%. I'm like, that's not the way to go. If you want to grow and stuff.
Oh, absolutely. I have, it's just, you can't put a price on being able to bounce ideas off someone in a confidential manner. That's really like what I like to say. There's nothing more important to that. And, it really, two heads are better than one, three heads are better than two. And especially if you have some strong relationships like I have with, hedge fund managers and, founders of private equity firms. And, like take this RV fund, for example, like we're currently considering, taking in a couple of, we're going to take in a co-GP on it, not because we need to, but because I'm thinking of the long term, and I want to, because I know I rather own less of more than more of less.
Yeah, it's very interesting. I did have a question about your, do you guys also manage and run the properties too?
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that AnVi Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire and a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to anviinvest.com for more to see if you qualify. And thanks for listening.
So no, we are third part. We use third parties, but I have very strict standards for anyone that is managing the properties in terms of putting in their own capital to the deal before close, and really keeping them honest in terms of meeting, their pay is directly correlated to the performance of the building. If they don't hit certain NOI hurdles, their pay is going to go down, or they have to put more equity in. A lot of times, like they'll sign NDA agreements because they don't want the rest of their their customers, their building owners, knowing that they're putting equity into some buildings and not others. But I will not hire a property manager unless they have skin in the game.
So the property manager also own part of the GP then,
So
and LP.
yeah, so basically they'll put in money, and I'll usually, it's an LP, but I'll take away it's usually like 25, 30. It's not that much money, so I'll let them in at even money. And basically after, like, we structure, it's almost like stock options. Like if they if they beat the budgeted NOI hurdles for 18-month period, they'll be rewarded with 1% of the GP.
That's nice, man. That's cool. So that's very interesting. So you work with third party. Now, the question I wanted to ask you was, this will be interesting for people, right? You said you're asset agnostic and then you choose. Now, some people will argue and say, bro, we're still on. I'll go switch it on. But some people also say, hey, if you're asset agnostic, you're not really a smart person in one particular asset, right? So now you have your hands in 5 different things and you don't know anything about any of them, right? So how would you respond to that?
Yeah, I would respond that in an asset class as I think as simple as real estate, that I would counter that if you're not asset agnostic, you're at a humongous disadvantage in that because there's only so many good deals to go around and special situations. And if you're limiting yourself to Class B or Class C multifamily and that's it, your potential deal pipeline is just not going to be strong enough to sustain growth to the level that your firm needs to achieve success, in my opinion. And real estate is not rocket science. You're collecting rent and you're paying expenses, and just coming from the background that I did, where I was analyzing metals and mining, coal companies with having to deal with FX fluctuations, offtake agreements to Sri Lanka, mining, unionized workforces, legacy reclamation liabilities. I mean, real estate is relatively straightforward, black and white, and simple. And the barriers to entry are much lower as opposed to what I used to do, where you had to be what's called a quib, which means you manage in excess of 100 million of capital to be even to be able to play. It's because the barriers to entry are so low. And because I'm so specific in that I only will require an asset where I know I could flip it the next day for 10 to 20% profit. I feel that it's kind of the other way around, that if you can't put together a quantifiable track record in making money in a myriad of different real estate types of asset classes, then I personally wouldn't feel comfortable investing with you.
Yeah, okay. That's, because I think your trick is you're actually partnering with the experts in that kind of field to manage their property, right? If you were to manage a retail center and a multifamily and single family and Airbnb, you're going to die, right? I mean, by yourself. So you're partnering with those kind of people in those aspects, and then you're bringing the money, kind of overseeing the underwriting, right? Is that what you're doing?
Absolutely. So I want to be clear, like, I'm not a fund of funds. I'm not giving money to I'm investing myself. But, take the RV space, for example, in Alabama. There's a Yahoo Finance article that's going to be released in the next week or two announcing our partnership with a local, well-known and well-experienced RV park property manager. And
It's Brandon Turner, isn't it?
it's not, but basically I need to, I rely on and also, like, in certain cases I will put, like, the management, we will go back and forth and spend a lot of time and money on these management services agreements, giving me a certain amount of operational control or input into, like, for example, like these RV parks. Just to kind of give you an interesting statistic, is 75% don't take online reservations. You have to physically call. I mean, it is so archaic and so inefficient. And like one of the strategies that I'm pushing to increase efficiency is implementing chatbots to be able to field any type of prospective tenant or guests questions, all the way being able to guide them through making the reservation themselves. And that's not something that our existing property manager did or necessarily wanted to implement, but I was very clear in the MSA that I am going to be able to implement certain operational procedures that I see fit to increase the value of my assets.
Wow, that's cool, man. That's very interesting. Now, a lot of the listeners that listen in, they're not at, your kind of level, and they're thinking, okay, great, Ben's sitting on $50 million of cash. He can do all of this. Now, if somebody's starting and they're like, hey, I'm just trying to buy the next fourplex, eightplex, I saw something down the street. What can I do to kind of get in the market? Because there's always something on the news. You can never get in, right? Oh, Trump's getting elected. Oh, Trump's not getting elected. Oh, there's COVID. There's fires in LA. So there's always uncertain times, right? Because otherwise everybody will do it. So what would you advise to those guys who are just star girls trying to get in the first or the next deal? Like, what can they do?
So to enter into the market as an operator on your own, I would implement something that my firm does all the time. Basically offer a 4% cash finder's fee to anyone that will bring you an off-market deal. It doesn't matter if it's a broker, a 15-year-old kid who has a grandma that owns something. Hit the streets and publicize that you will pay a 3 to 4% cash finder's fee, because it is really all about your sourcing capabilities.
What does that mean? So if it's $1 million, you will pay them 40,000 cash?
Yes.
Okay.
Because
Wow.
because you are, but however, you're only going to buy it if it's such a good deal that 40 grand is in the grand scheme of things is meaningless. You're getting it at a 30% discount to market. So, and they only get that 4% if you close. And if you're only going to close, if it's such a good deal and you're getting it, say, a 20-30% discount, that it makes sense. And on top of that, like, how do I beat out established RV park operators and funds in the Southeast right now? Every broker knows that on top of what the seller's paying, I will offer them another 100 basis points on my end if they bring an off market deal to me first, and I'm the first call. I will take care of you. And that's I can't even tell you how many times that's resulted in me getting the first call and me having a robust deal pipeline. Because, like I said, people in this business are penny wise and pound foolish, and they don't understand that, even if it's a $5 million deal and you're paying, another 100, 200 basis points, in the grand scheme of things, if you're getting it at the proper discount, it's, and you're buying future goodwill. It's a no-brainer, if you ask me.
And where do you find these guys? Or, if you just start going to meetups and like telling people this is what you're doing, or you go online on Zillow or
So
something? Yeah.
I would start talking to, so if you're looking to buy smaller, like a duplex, triplex, or a 4 unit, start talking to residential brokers in the area that have been around, or small, or brokers that work, commercial brokers that work at traditionally more residential firms like Houlihan Lawrence, firms, and even, just make yourself known to just really anyone in the industry. And then also another thing, I don't like to say this that often, but another very valuable way to source deals is skip tracing using the right person. And on top of that, conducting not direct mail, not phone, mass texting campaigns. The hit rate on a texting campaign is quadruple that of a direct mail or a phone call.
Wow, that's interesting. So now let's say, okay, you've somehow managed to find a deal that is interesting. It's $1 million, but you only saved up 70 grand, and that's 40 grand just for that. Now you need another, let's say, 200 grand. So what would you tell the new people, like, hey, I don't have a lot of experience. I don't have 10 deals under like my bag like you have. What would you do?
So you need to find a partner. You need to find someone, a high net worth individual, or someone that has experience, and because you're not going to be able to get a loan, you're going to need them to sign, to sign the loan. So basically, if you can display that you are able to get good off market deal flow, that's the hardest part. If you can display that you are able to get off market mispriced off market deal flow, it's relatively easy to find a high net worth person to come in with you, because everybody's looking to make money, and a lot of times in that point you might not even have to put in any money and still get 50% of the deal.
Yeah. That's a really good point. For people who are listening, a lot of the listeners we have are W-2 employees, and I actually have a W-2 job still. So, for example, I live in California. Everybody's making 10 grand a month, right? Let's say they're making 10 grand a month. Now you can qualify at 50 DTI. You can qualify up to, if you have no expenses, let's say you don't have any debt, you can qualify up to $5,000 a month in mortgage payments. So you can qualify for $700,000 of property with that W-2 income, right? So
And
now,
and
yeah.
then there's also, people don't really look at it, but there's a lot of Fannie and Freddie type of
Oh yeah.
loans that will give you 95%. If you're like, if
LTV.
you buy a quad plat or 4 unit, and you're going to live in one, there's a
Mm-hmm.
lot of very favorable loan programs out there that not that many people or even know exist.
Yeah. So for what what Ben's talking about, guys, is if you're buying a 4 unit building in, let's say, in Orange County, you can qualify for up to 95%. They will lend you the money for up to, I think it's 1.2 million or something crazy. So you only need like 100 grand to buy a 1.2 million dollar property. As long as you can make you need to have certain things that you need to have the income to support it, because they will look at your job. But you can make your sister sign, because my sister signed on this house I'm sitting on, so that I can qualify for it, right? So now she owns part of the house. Now, maybe you both win, right? So you can always get your mom, your dad, your uncle, your brother, someone you trust to sign on the loan and get in on the deal. So you don't really need, what Ben is saying is, you don't really need $1.2 million to buy a $1.2 million deal, right?
Or you can call me and I'll back you.
Yeah,
If
he'll
it's a
back
good
you.
enough
You call him, he will take a piece of the action,
deal.
but he'll bring the money, right?
Absolutely.
Yeah. Do you still partner with like just small time people, or no, you're only doing like, what's your minimum deal, like 10 mil?
Probably about 4 to 5.
4 to 5.
However, there's always a unique one-off special situation where, like right now, one of my smaller LPs that's been in like my past 5 or 7 deals usually writes for like just a $50,000 check. Contacted me, is looking to build out his own real estate portfolio. He lives in California. He wanted to buy industrial in California. I convinced him that he's got to go to Alabama, or he's got to go to some red state in the Southeast. And basically, I've used my connections to be able to source him a $2.3 million mobile home park. And basically, I guess you could say, tutoring him on how to source, acquire, finance, and manage one of these assets for him. And he's going to give me a slice of equity for my time, and I don't know, maybe a consulting fee. But even though my minimum deal size for any type of like syndication or fund is between 5 and 10 million, there's always special situations. I mean, like about a year and a half ago, I bought a 3 unit in Fairfield County, Connecticut, which is where I'm from, Greenwich, is a gorgeous area. I paid, 730, and I'm about to put it on the market for 1.5. So,
What, three
not
years ago?
no, like a year and a half.
Oh, wow. Did you do some kind of work on the property to improve it?
The address is 302 Soundview Avenue in Fairfield, Connecticut, if you want to look it up. It's a very interesting, off-market deal, a special situation where the owners, the sellers bought it because it had a cell tower. They were more interested in the cell tower income. They sold, and they ended up selling it to me for less than what they paid for it 6 years earlier. There's 3 apartments. The average rent was about $2,000 when market was like 3,500, and the units were all renovated. I just got the tenants out, put the new tenants in, maybe put 10 to 15K of aesthetic capex in, and it's a gorgeous like castle looking building, and I'm confident I'm going to put it on the market within like 2 or 3 months for like 1.6 and hopefully get 1.4.
Mm-hmm. That's
But
crazy, man.
yeah, but I try to
And
shy away from those deals. Like, I bought an $8.5 million deal in Milford, Connecticut. Like I said, I'm hoping in 18 months to be able to sell that for like 18 to 20 million bucks.
okay. Wow. That's interesting. So you still will work with people even though, they're still doing just the 50K and, you still have those kind of clients too.
Yeah, I mean, I have investors that have been with me for a very long time and have just consistently written $50,000 to $75,000 checks, and they're loyal. And it's not only just about them. If you do well by somebody, they're going to refer you to other people. He's a doctor, and doctors are always looking to invest in real estate. So I've probably gotten 5 to 10 referrals from him already, and that's just the beginning of a lifelong relate. You got to think long term and not just be so obsessed with the cash amount now. You have to look at it as a long term investment.
Wow. Yeah, that's very interesting. Is there any other oh, I always like to end with this. What do you think of the current economic conditions in 2025 going forward? Is it a good time for people to get in or
I mean, just based on my strategy, I think it's always a good time to get in as long as the asset you're buying, it's a special situation where you're getting it at a 20, 30% discount to where we trade online, and you have clear defined levers to increase revenue and NOI, whether it was mismanaged, and you can increase bloated expense ratio. I mean, you're at a point now where a lot of syndicators are in trouble now, and unless they can get rescue financing or they could get, do incremental capital calls. There's probably going to be some distressed sales or some non-performing loans or, banks taking back some property. There's going to be some distressed opportunities on the horizon.
so you would say it's looking good for the near future to keep going?
I mean, I think it always is, as long as your cost basis is good enough, makes sense. I mean, listen, like if you can buy a deal now that pencils out well with rates at above 7%, it's an inherent interest rate arbitrage play.
Mm-hmm.
Because if it works, like I've been saying this for years, like if a deal works when you're borrowing and works well at 7.5%, it's going to look a whole lot better when rates are down to the mid sixes or low sixes. As long as it's a decent investment on its own merit in the mid sevens, I would do it all. I would do them all day.
Yeah, it is very interesting. Once you start learning these things, for example, I never tell people how to do the deal because, this is not financial advice, but for example, my portfolio is not that very big, right? But it is, I lose on average, let's not include taxes just for fun, because when you include taxes, then it's not a loss, but I lose, let's say $3,000 a month on my properties a month for every year. So I'm losing 40 grand a month, right? I mean, 40 grand a year, right? But my property values, even at a nominal 4%, 5% appreciation, goes up by 40 grand a month because that's how much assets I control. So now for me, because I have another partner, spending $1,500 a month it's like nothing, right? It's not a very relevant because we have income. So we make 250, 300 a year. So for us, spending 1,500 a month is okay. We can deal with it. But we're doing it because we're making 40 grand a month in appreciation, which is insane play. Now, that's what I've realized. Like I live in Costa Mesa, which is close to the beach. Doctors come in and buy these big assets, and then it'll be like a $5 million asset, and they'll lose 20, 30, 40, 50 grand a year. And then they'll sit on it for 5 years and make $5 million. It's insane. Now, that's not an investing strategy I recommend for people. However, if you're making $5 million a year because you're a surgeon, 50 grand a year is nothing for you. And then, so they're just doing that and seeing if it'll make them a play. Do you ever invest like that or no?
Not really. I'm a deep value, bottoms up cash flow guy. And, I guess like one piece of advice I would give to your listeners is, the old American dream of getting married and then plowing all your equity into a single family home and then you're set is dead. I don't own my home. I rent. I rather pay 20 grand a month in rent than buy a house because just the amount of tax benefits and the amount of money you can make by reallocating that, whether it's a 400,000 or $1 million down payment into something else over, a 5-10 year period is just astronomical. If you put money into a single family home, it's dead money. It's dead. And, that's one other piece of advice I would give. It's a single family home ownership, you don't get the depreciation. If everybody's different, that's just my piece of advice. I'd rather pay 20 grand a month in rent than own a house.
Yeah, that is interesting. Let's end with that. This will be a fun debate. So I am on the opposite camp, right? So because I want to look at the stats and stuff. Now, for you and a lot of my friends, because they're in real estate, they're like high net worth and income earners like you. So I have a buddy, Rich. He lives in San Diego. He has his own podcast, and he spends $12,000 a month on rent, and he lives in a high rise. So he says the same thing. He says to own that house, you would have to put down 300 grand, and then spend 25 grand a month in terms of just making that mortgage. Or he says he could just pay 12 grand and live there and not worry about any maintenance or HOAs or anything because they pay for everything, right? However, that is for you guys who are very smart and very niched out and making a lot of money. For most Americans, the net worth of most of their net worth is in their home, right? So the people who rent have a net worth of $5,000 in the US. The people who don't rent, guess what? It's in six figures, right? Because of the home equity over a period of time. Now, looking for 2 to 3 years, of course, it's kind of like back. But if you look at any 10-period time frame, you can never go wrong owning a house, right? So what would you say for that?
I mean, I would disagree. I'd say good luck getting a HELOC or selling your home in any type of recession or depression. You pay over you try to pay off. You think equity in your home is worth something until it's not. It's not
Until
cash
nobody
in the
wants to buy
bank.
it, right?
Someone has to buy it.
Yeah.
And I would be wary of things are volatile and it's not a cash flowing asset like commercial. Like there's all like in commercial real estate, if you have equity in it, it is based off underlying cash flow. You're paying that, and you have depreciation. There's just tons of benefits as opposed to even like I know people that buy $2, $3, $4, $5 million houses all cash. I mean, because they can, but some of them in Martha's Vineyard, they're making, they made 3x in the past couple of years. Good for them. But I would not try to overvalue what you think your equity in your home is actually worth and what it could be worth in any type of recession.
Yeah, that is a good point. I think you have to look at it from your point of view and from your case. You could do a lot of case scenarios. For example, if you take my house, I bought it in 2020. Everybody was laughing at my face when I was buying it. I bought it for 1 point something, and at that point, I was paying about a couple grand in rents, right? because I live in Orange County. So now my mortgage is, let's say it costs me $7,000 a month, right? However, I do have a roommate. So I'm paying about the same. I'm only having like $3,000. I'm paying every year. My house has gone up 100 grand a year for 3 years straight. That's insane. So
I would call
different
that
life.
more of a special situation,
Yeah.
opportunistic buy than
Yeah.
the
Yeah.
standard just buying a house at a market rate or at a market price, not a deep discount. And I'm a true contrarian. Like when everyone's running one way, I'm running the other. Like when Bitcoin in 2020 was at 15,000, I'm dumping money into VC funds and and crypto hedge funds when no one would touch it with a 10-foot pole. I firmly believe that you cannot make money by following the herd and doing what everybody else is doing. And if people don't like question or think what you're doing is a little crazy, you're not doing the right thing.
Yeah, that's such a so much truth to it, man. But I don't want to keep you for too long, Ben. Any last words of wisdom?
Yeah, a good book I'd say for your listeners is How to Build a Real Estate Empire Using Other People's Money.
Who was the author on that one?
I'm not exact. I forgot who it is, but I read it like 6 months ago, and I was just flabbergasted with how many of the lessons that are in that book that really are just attributable to me, or just are relevant to me in this stage of my career. It's I anyone that's looking to get involved in this business, I tell them to pick up that book and read it. It's a very simple, easy read, and if like people trying to buy a duplex, triplex, you need to read that book. In my opinion, it's
how to
build a real estate empire using other people's money.
Okay, yeah, I'll look at it later. But that's cool, man. Thank you so much, Ben, for coming on the show. And if people want to get in touch with you or have questions or want to take part in your fund, are you still raising capital for anything?
Yeah. We have a few syndications out, and the fund is approximately, I think, like 68 or 70% full. But there's still spots open. If you can get in touch with me, our website is rwcapitalinvestments.com. LinkedIn is just Redwood Capital, and the company email is operations@rwcapitalinvestments.com. And I'll give you my personal email. Reach out to me anytime. It's B Spiegel, SPIEGEL @rwcapitalinvestments.com.
Spiegel, is that Italian?
It's German. It means mirror
German.
for German.
Oh, nice. Cool, man. Awesome, man. Thank you so much. And the fund is for accredited investors, or?
Yeah, accredited investors only. We do have, the fund is the first, 20 million of assets are coming from a forced seller, of which, the first one is we had to close. We're going to have to close before the fund formally, is closed. And that one's closing in about, 3 weeks. It's in Mobile, Alabama. It's a very interesting special situation. I'd love to chat with you guys more. It's, I don't want to say, whatever. It's over a 2x equity multiple, in a 3 to 4 year hold period. It's a very unique situation.
That's very, very high IRR, almost 25, 30, huh? That's cool.
And that's net to LPs.
Yeah, that's awesome, man. Thank you so much, Ben. Let's chat again soon and see where you guys are at.
All right, Vince, thanks so much for having me. I really appreciate it. Have a great day.
Yeah, you too. Thanks, Ben. That was really good.
You think so?
Yeah, dude, it was good. That was very good. I liked it. And let's cut it up, and I'll make some posts, and I'll have my team reach out to you and maybe tag you on IG, get some views.
Yeah, perfect. I tried to pivot to make it more relevant to your, your broader audience in terms of, beginners, and trying to just give them practical, advice.
Yeah, I'm super nerdy, so I like all the stuff you were talking about. So I was also trying to, keep it for more layman's term. But yeah, that was awesome, man. I think if you close it out, I think you have to leave it on for a little bit so it streams and uploads your site.
No problem.
Yeah, cool, man. Thank you so much.
Have a good weekend, my man. Take care.
Yeah, you too, boss. Thank you. Bye.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.